Hello, everyone, and welcome back to another episode of BIF Bites. I'm your host, Jerry, joined, as always, by my co-host, Mike. How's it going, Mike?
Jerry, it's going well. I'm ready for fall weather and football, college football, but overall it's going well, and glad to have you back. I don't know if we've had an episode since you've been back from Europe, but welcome back. Yeah. You were very missed.
Oh, thanks. Appreciate it. Yeah, I enjoyed myself over across the pond, but ready to get back to work and get back to the CFP grind.
Let's do it.
Yeah, definitely. So lately I've been up to my eyeballs in bond yield, yield to maturity, yield to call. I've been rewriting some of the curriculum to be a bit clearer for our students in that department. What have you been kind of up to lately?
Yeah, and I just want to tell you, I'm thrilled with what you're doing. You're in a wonderful way breaking down some of the mystery that surrounds these various calculations and issues with bonds. So I've just seen a little bit of what you've done so far, but I thought, wow, this is really good, and I think the students are really going to love it. So what I've been doing, I'm always involved I'm looking at a lot of exam questions now, but we are excited to start rolling out some brand new videos to our video library, particularly about calculations and formulas and such. So I just want to encourage the students to watch for those as they roll out. I think they'll really like them, but we'd be anxious for their feedback.
Oh yeah, I got to watch a couple of those, and yeah, you've been doing a lot of work there. Those are great. Some new ones just came out on our YouTube page, Boston Institute of Finance. If you search that on YouTube, it'll get to our homepage. And yeah, there's a bunch of kind of calculator tutorial videos that really useful. I even learned a couple tips and tricks there, some shortcuts that I didn't even know. So
yeah, it's pretty amazing, isn't it? And we each, on our staff faculty, we each have our favorite calculator, but it's interesting. You watch someone like, oh, I never thought about it that way.
Yeah.
So you're right. Yeah, I've learned some stuff too.
Perfect. Well, you want to get right into the meat of things and get things started with our question of the episode?
Yeah, and I think this is one, right, that a student sent in to you, correct?
Yeah, students sent this in to me. I'm not sure where they got it from, but I really liked it because it's definitely an area that people tend to have trouble with, and it's the Kiddie tax. Kiddie tax was simplified a bit with the Tax Cuts and Jobs Act. Before it was a pretty convoluted system, and while it's by no means simple, it is simpler than it was before. But people do still just have a little bit of trouble with it because there's a couple layers to the Kiddie tax that you have to go through. So I'm gonna pitch this one to you, Mike, and I want to see kind of how you break it down.
Okay, yeah, I think this is a great topic, and I would be shocked if there isn't at least one Kiddie tax question on the national exam. But it is so relevant in just real-life client work, too, so this was a good choice again.
Yeah, definitely. So, at only 13 years old, Melissa is a promising figure skater with dreams of Olympic competition. When she was born, her parents established a Section 2503C minors trust on her behalf. Melissa's parents are in the 37% marginal federal income tax bracket. The trust assets, which are now substantial, are invested conservatively in bonds and bank-issued certificates of deposit. In the 2019 tax year, $15,000 of income from the trust is distributed to cover private figure skating coaching sessions for Melissa. Assume that Melissa has no other sources of income. How will the distribution of trust income be taxed? Will it be A, the distribution of unearned income from a trust for a minor's current enjoyment will be taxed under Kiddie tax rules. The amount of tax that applies to the $15,000 distribution is $1,390. Is it B, the distribution of unearned income from the trust for the minor's current enjoyment will be taxed under Kiddie tax rules? The amount of tax that applies will be $3,204. C, the income will be taxed entirely at the fiduciary tax rates applicable to trusts. The amount of tax that applies will be $3,908. Or D, The distribution of unearned income from the trust for the minor's enjoyment will be taxed under Kiddie tax rules. The amount of tax that applies to this distribution is $4,846. And I know I just threw a lot at our listeners right there. If you're a more visual learner like I am, this same question will be in our newsletter if you want to take a look at it.
Ah, good.
So what do you think, Mike?
What do I think? Well, here's an idea. As a hardworking CFP, we want to look at alternatives as well, right? So here's just an idea for these parents. Take all of the money that is spent on lessons and ice time and training and all of that, invest it, and then when the child is, Olympic age, give them the money. I just think for comparison's sake,
Mike, you're just like some of my favorite students. They're in the industry and they see these questions and it's like, these parents shouldn't be doing this. They should be doing something completely different.
But I say this, in fun because I fully supported my sons. They were swimmers and soccer players, and I fully supported that. So I'm kidding, of course, but it would be interesting math. Maybe we'll do a calculator video about that.
Yes, future project for sure.
So, and I think youth hockey's even worse. So, that might be a fun question to have. But yeah, so you break this down, and I think this is so important. And I think where we get lost is that separation with unearned income and earned income. My hope is our question would only deal with unearned, and that would be my prediction too. But it's just the steps. It's those repetitive steps. So the first thing, for this year, we've got the first 1,100 of unearned income is not taxed at all.
Yeah, tax-free, baby, straight into your pocket.
And remember, too, that we're only talking about unearned income for this Kiddie tax thing.
Right. Things like, most commonly, you'll see dividends, things like that. Less common, you'll see things like royalties. Say you have some of these like child actors who are receiving royalty payments for their performances. That'll be unearned income. It's not, the newspaper routes, the, mowing lawns, things like that. That would actually qualify as earned income.
Yeah, so that's, kind of the first thing. And then so we just take the total. What do we have here? 15,000. So we would first subtract 1,100 from that, and we don't have any tax on that. And then the next 1,100 is taxed at the child's own rate.
Typically, this is also zero because unless the child is working and is in a tax bracket, typically children don't have enough earned income to actually get taxed on it.
Good point. Really, really good point. So that's the first part. And then, so we draw the line there. And I remember doing these, longhand and draw the line. So how much is left then of the unearned income? And that's the part that we're going to look at with Kiddie tax.
So real quick, just to add that up. So we got the first 1,100 is always tax-free. The second 1,100 is usually tax-free unless the child has a job or something like that that would push them into a tax bracket. So really we're looking at 9 times out of 10, the first 2,200 is tax-free, and we can subtract that right off the $15,000 in this question.
Yeah. Okay, good. So you're tracking. So what's that leave us with? 12,8?
Yep. $12,800 left over that will actually be taxed.
Yeah. So now the last piece is just, okay, at what rate? And before the Tax Cuts and Jobs Act, it was at the parents' highest marginal rate, right?
Right. Now it's based off of trust tax rates, if I'm remembering correctly.
You're right. And here's a nuance, which maybe makes it a good test question. One of the differences here is it's actually marginal rates with the trust and estates income tax rates, whereas in the previous law it was just whatever the parent's highest marginal rate was. Now you actually apply the layers of marginal tax to that amount, that 12.8 that we're talking about.
So break that down for our students. How does marginal tax rate actually work?
Okay, so we're starting at 12.8, yeah, and the first 2,600 of that 12.8 is taxed at 10%. Mm-hmm. And so we could write beside there $260. Now we subtract that 2,600. We're down to 10,200 left. So the next bracket is 24%. And so we have in that bracket, we have $6,700. And let me give you what that second bracket is from 2,600 to 9,300. And so that's 6,700. The next 6,700 is taxed at 24%. Big jump. So that's $1,608 added to the column. And so now if we take that $6,700 away from the $10,200, we have left $3,500 of unearned income to be taxed. And that next bracket, another big jump, 50% jump, goes to 35%. And that bracket runs from 9,300 to 12,750. And so that 3,450 will be taxed at 35%.
Right.
Which adds another 1,225 to the total. And then I guess we would even have in this one, $50 more?
Yeah.
That's taxed at 37%. But we add that up, and we've got $3,204.
Right. And now for students listening at home and thinking, oh man, Kiddie tax is impossible, I'm never going to get these questions on the exam. They do provide you a lot of resources that help you answer these sorts of questions on the exam. You do get the tax tables for trusts, so you'll be able to see the dollar amounts and the percentages that they're taxed at. So when you're solving these types of questions on the exam, I recommend students draw a little pyramid. And at the base, you have the first $1,100 that's tax-free. Then the next level is another $1,100 that is also typically tax-free, but it's, quotation, the child's tax rate. And then the next level above that is the first level of the trust tax amounts. And you just work your way up this pyramid, filling in the dollar amounts and how much each one's taxed. And then at the end of it all, you just go down the side and add up the totals, and that gives you your total tax amount.
Excellent. Yeah, so anytime they run into a practice question between now and the exam, I would do that. Draw your little chart and do it, and then you can even visualize that when it comes test time. But this is another easy points if you'll just get comfortable and practice the steps.
Yep. And it's really the pyramid is a great visualization tool to help you, keep track of these different levels. As you go up, the tax amount gets higher and higher.
Yes, and I really, if I had to bet what one would see on the exam, it would be all unearned income. But don't panic if you happen to see where they do have the paper out where they're earning $5,000 a year or whatever. That what we just did always determines how much is going to be taxed of the unearned income at the estate and trust rate. After that, you can do more of a regular tax calculation, which just adds really another step to the process.
Definitely. So pulling it all together, we get the correct answer of the distribution of unearned income from a trust for a minor's current enjoyment will be taxed under Kiddie tax rules, and that amount is going to be $3,204 when we add it all up.
There you go. And that's what I would predict you're going to do on the exam. So it was a pretty good question choice.
Perfect. So, Kiddie tax, lots of pieces, but not all that complicated. You just got to stack them in the right order, and you're good to go.
Absolutely.
All right, Mike, we got a topic that is on a lot of people's minds, a lot of information, and I would say misinformation flying around out there, and it is the new fiduciary rule changes that are going into effect for the November CFP exam.
Yeah, we've heard a lot about this for a long time, and we will continue to well into implementation, which I think is October of 2019.
Yeah, they kept moving it back. They announced this, I want to say, a year and a half to 2 years ago, and a bunch of the firms pushed back, so they delayed it, and there was a lot of hemming and hawing, and now the CFP board decided, it's going into effect. They did delay it one more time where it's going into effect October 1st, but it's not going to be enforced until 2020. But it will still be tested on in the November 2019 exam, even though it's not going to be enforced until next year.
That is my understanding as well. And I actually called CFP board this week just to absolutely confirm that. And they said, yes. And then I kind of give them a hard time and said, well, why don't you send something out or post it on your website or something? It's like, but we thought that's kind of common sense, isn't it? And I said, well, I don't know, but it would be so easy to say, by the way, it will be tested, but it's not going to be enforced until 2020. So I'd be shocked if they took my advice to post something, but yay, you can try.
The person you were talking to was just like, I just work here, buddy.
That's right. Hey, man, don't hassle me. This isn't my code. Come on.
Definitely. So, we definitely recommend all students studying for the November exam, go to the CFP board website, get the copy of the ethics handbook, read that cover to cover several times to get ready for the exam. Can't overstate that enough. These are typically the questions that are freebies, so long as you put in the work and actually, read the employee handbook, basically.
Yeah, good advice, and multiple times reading it. The good news piece from a testing standpoint is this new code and standards from a content volume is far smaller than the previous one, so there's far few pages to have to study as a testing item.
Yeah, definitely. So really good time efficiency with it now compared to the old handbook, which was kind of a monster as far as all the rules and regulations in it.
Yeah, they really produced a much more readable document this time, so I applaud them for that. But I think that the main advice here is, folks, don't panic. You've got this.
Yes.
You'll see when you get in here that there's things that have always been there, and then just focus on some of the major changes that happened.
Definitely. And to help people out, the CFP board did put out a dozen case studies featuring questions that will be affected by the fiduciary rule changes. And I figured we could just run through, one or two of these just to kind of give them a shot, see what we think. And I'm sure we'll be coming back to more of them in future episodes.
Yeah, and the early ones of these case studies kind of focus on that fiduciary duty, and that's, I would guess, would be the most heavily tested piece of this. And so that, in their description, fiduciary duty is three different duties: duty of loyalty, duty of care, and duty to follow client instructions. And that's where these case studies put a focus, and I think it's perfect for the exam, because I really believe if this makes it into the exam in November, I think the question will look like one of these case studies.
Yes, definitely. So let's dive into this first case study here. Sarah, a CFP professional, is engaged by Betty, who is retiring soon, to provide financial advice. Betty has most of her retirement funds invested in her employer's 401k plan. Sarah does not obtain any information about the 401k plan because she assumes that there are more investment options available in an individual retirement account, an IRA, than in Betty's 401k plan. Based on this, Sarah believes Betty's portfolio would be better off in an IRA. Sarah properly discloses her material conflicts of interest to Betty. Sarah then recommends that Betty take a distribution from her 401k and roll the assets into an IRA, which Sarah would manage. Sarah intends to analyze and recommend an investment strategy for the IRA after the funds have been distributed to the IRA. Did Sarah satisfy her fiduciary duty? I really like this question, Mike, because this happens all the time. When I was an advisor working in the industry, rollovers were the bread and the butter for most advisors. A lot of new clients would come in from 401k rollovers and setting up IRAs that you would manage. So I feel this is a situation people are going to run into a lot.
Yeah, universally applicable here. And I'm going to say instinctively, I bet Sarah's right. But where if a complaint ever ensued about this, and when you get into these case studies, they write really long explanations. So take the time to read through those as you study the 12 cases. But really, where Sarah opened herself up for not fulfilling this duty is that she just didn't gather up enough information. She didn't analyze the existing situation enough. She just kind of very quickly went to that rollover, and that would fail. That would fail the fiduciary duty that she has. And I think it's the duty of care was the one that they referenced in this one. But the short answer is just she just rushed it, and she didn't follow those steps.
Yeah, the red flag for me in this question when I read it was Sarah assumes. Whenever you see a financial advisor assuming something, that should set off alarm bells in your head.
Yeah, good point. Very, very good point. So again, study it intensely when you get into this, but just know if we're rushing and we're making assumptions, we may be setting ourselves up.
Yeah, and that's important because, this is a situation that happens every single day. You will research 401k plans, and, 99% of the time, Sarah would be right. Most 401k plans are fairly restrictive in their options, and IRAs give you full freedom. So 99% of the time, Sarah would be right. But there are those corner cases where Sarah would be wrong. The 401k could offer like a brokerage link option where you can have any investment option. Or more importantly, Betty could have employer stock options or, and other investment vehicles in that 401k that, she could end up surrendering if she rolls it over.
Mm-hmm. Yeah, and so I like this one about retirement because, after all, remember when the DOL first started going down this path for fiduciary standard, it was about retirement. That's where this all started a few years ago. So I think that makes it great. It's so universally applicable, like you said, but then exam, it's a good exam question about retirement.
Definitely. Let's do one more quickly before we move on to our next topic.
Okay.
So Bruce, a CFP professional, is a representative of XYZ Advisors, not a real company, a registered investment advisor. XYZ does not permit its investment advisor representatives to charge a fee for managing assets in a 401k plan. Bruce is engaged by Heather, who is retiring, to provide financial planning. After obtaining information about and understanding Heather's personal and financial circumstances, Bruce helps Heather develop a goal of having adequate income during her retirement. Bruce analyzes Heather's existing account in the 401k plan and the plan's investment options, fees and expenses, services, and other features. All right, good job, Bruce, so far. He did put in the legwork. Bruce concludes that the management fees Heather will pay if she rolls over the assets into an individual retirement account will be higher than if she leaves the assets in her account in the 401k plan. Nevertheless, based on his review of Heather's circumstances and the analysis of the relevant factors, Bruce determines that such a rollover is in Heather's best interest. Bruce presents that recommendation to Heather and tells Heather that he would receive an ongoing fee for managing the assets in the IRA. Bruce does not tell Heather that she would not have to pay Bruce a fee if she continues to invest her assets in the account of the 401k plan, as he would not be advising on those assets. Question: with respect to Bruce's duty to disclose conflicts of interest, which of the following is the best response? Either A, Bruce has no material conflict because Heather understands that Bruce will not be paid for his services. B, Bruce satisfied his disclosure obligation when he disclosed his fee for managing the IRA. C, Bruce did not fully disclose to Heather the material conflict of interest that his recommendation presented. Or D, since Bruce sincerely believes that his recommendation was in Heather's best interest, he was excused from making full disclosure to Heather. What do you think, Mike?
I think the best thing here would be let's hope the marriage lasts. That's probably the greatest weakness to getting a complaint ever on this. But being asked by the fiance to to get into this, I actually don't like this question, but I think it serves a good illustration. I get the whole thing that if she left it here, there's no fee and he's going to get a fee. He did disclose he gets a fee. But this one to me, Jerry, is almost like, are you sure you want to do this? You probably really don't want to do this, do you?
This is a tricky one. It really is, because Bruce came really, really close, and it's not that seems to be intentionally hiding anything from Heather. He's disclosing the fees. He put in the legwork. He did the research. He's making the recommendation of his best interest. He's not just chasing a commission or anything like that. Really what it's coming down to is, the things left unsaid, or not even unsaid, but more just, maybe just a miscommunication in that Bruce assumes that Heather knows these things, so he doesn't bother bringing it up.
Yeah. So it's a tough one. And to draw the line on, but I think it's a good illustration that for the exam, if you really don't know, if you really are having a hard time sizing it up, I would recommend erring on the side of more protection for the client rather than less protection for the client. And this was one of those, it's like, okay, well, I'll go along with that. But man, I think it was pretty on.
Yeah, I agree. Always lean towards the very conservative side when you're unsure about a question.
Yeah, that's a good lesson. But again, there's more of these and some good tidbits to pick up, study all 12.
Yeah, definitely. So the correct answer on that, by the way, was C. Bruce did not fully disclose to Heather the material conflict of interest that his recommendation presented, specifically because he did not disclose that he would not be collecting a fee by leaving it in the 401k, even though he did disclose that she would pay more of a fee by rolling it over to the IRA. Just the fact that he didn't spell it out that there would be no fee for it in the 401k since he would not be advising on it, makes it fall under the not fully disclosure.
Yeah, and on my copy, I put an asterisk on that one in protest. That I'm not in full agreement on this CSP board.
It's kind of like you have a plumber come over to do an inspection, and the plumber gives you a quote, and you're like, no, I'm not going to go with you. And then the plumber is in trouble because he didn't disclose that you won't be paying him for not actually doing the job.
Yeah. So, and there's a few more cases like this in that lineup. So, there's others I disagreed with somewhat. And you may do the same, listeners, as you go through there. But just remember, you're just preparing, how do I take apart these things and get to the right answer?
Right. And that kind of goes back to what we talked about a bit on the last episode, and it's separating real world from test world.
Mm-hmm. Yeah. And that's something else, just again, the stuff you're working on, Jerry, that breaks down real world and test world. It's just really valuable stuff that you've been working on lately in those regards.
All right, Mike, I want to wrap up the episode with something that's relevant for just about everyone, because I would say the vast majority of Americans will come across this at one point in their life, and it is retirement plans and the alphabet soup of all of those different options out there. How do you keep them straight?
401k, IRA, SEP, EI, EIO. I mean, that's what it feels like.
Yeah, we got 401ks, 403bs, 457 plans, SEP, simples. By the way, even though it's called a simple plan is never simple.
It's not simple, and there's more than one.
Exactly. So how do people keep this straight? This is a question I get from students all the time. Especially students making a career change, students who have not been in the industry. Really, how most people in the industry get these things straight is they're just exposed to them day in and day out, just because it's such a large part of clients' day-to-day investment activities. But even professionals who have been in the industry for years and years and years, some of the more obscure plans, they are not comfortable with at all.
Sure, and understandably so. And this is an area where in the first episode of BIF Bites, you and I heavily promoted the use of handwritten flashcards. This is a good place to use handwritten flashcards for these different plans and start getting the nuances down to bullet points.
Right. And the way I start organizing those for when I make my flashcards is I make 2 piles. And I have one pile be my personal retirement plans, and those are, IRA, Roth IRA. There are a couple kind of ones that blur the lines a bit, but usually fall under the individual side, things like KIOs and individual 401k plans. These are the plans that an individual sets up. You take the time, you open an account at a brokerage firm, you fill out the paperwork, you set it up for yourself. And then my second pile is employer-sponsored plans, and these are the types of accounts that you can only get through a company, and these are 401ks, 403bs, 457s. The rule of thumb I've noticed is employer plans will always have the ones with numbers in them. Every single retirement plan that has a number in it is a employer-sponsored plan. There aren't any individual retirement plans that have numbers involved in their title.
Good point. Good point. I've never looked at it that way, but you're absolutely right. And of course, those numbers are the corresponding section of the Internal Revenue Code that speaks to that particular kind of plan.
Yep, exactly. So whenever you see a number in a plan title, that is your immediate red flag. Okay, this is a employer-sponsored plan, has to be set up by a company for its employees.
Good deal.
I make these 2 piles, and that's really the first level of just distinction between them.
Okay, I like that. I like that a lot. And I further segment that, and starting with the employer-sponsored side, and I break that down to qualified plan, and under that, it's either a pension or it's a profit sharing. Those are the only 2 types of qualified plans.
Mm-hmm. And taking a quick step back just to that qualified plan, Can you just give a quick breakdown for our listeners, qualified versus non-qualified?
Qualified means that they qualify under the revenue code and rules and with ERISA, primarily so that we have an employer deduction for the contributions made to the plan, and we have a plan that's not currently taxable to the participant. That's the big umbrella benefit of being qualified, whereas non-qualified plans, where we might get into some permissible discrimination, they do not meet all of the regulatory requirements to be called a qualified plan, and they tend to have more flexibility. And then there's a middle group, really, that are these tax-advantaged plans, like a 403B is not technically a qualified plan, but it's also not something like top hat deferred compensation.
Right, exactly. So on the employer side, you break it down further, qualified versus non-qualified.
Yes, and that's where the overlap of the rules come in knowing that there are certain rules that apply to all qualified plans. For instance, the covered compensation limit, it's $280,000 in 2019, and it doesn't matter what kind of qualified plan you're in. That's the most income that can be considered in any type of benefit formula.
Right. And that's important because I feel this is really where we start to lose students in their understanding, is keeping all the limits straight, all the contribution limits, all the tax advantage limits as far as how much you can contribute and have it be tax deductible. This is really where it all starts to kind of spin in people's heads.
Yes, absolutely. And so you just, and again, I'm visualizing these as bullet points on a flashcard. So we get into pensions. Pensions are really all about employer funding. There are no individual participant accounts. The employer assumes the investment risk. They're the most expensive plans because they have the most guarantees. Contrasted to defined contribution plans, there are defined contribution pensions and profit sharings. Most defined contribution are profit sharing, but they all play by the same rules. There's individual participant accounts subject to an annual additions limit of $56,000. That applies to all of those defined contribution plans.
Definitely. And honestly, there isn't really a magic bullet for that side of the retirement chart we're trying to draw here. You know, the employer plans are complicated. There's lots of rules. Some rules overlap between plans. Other plans have their own specific rules. You know, there really isn't a magic bullet for it other than just putting in the work, making those flashcards and making the distinction and practicing those distinctions.
Yes, that's great advice. And small bites, small steps. Master one of them first.
Yeah.
And then move on to another one.
Yeah, you know, start with something like a 401k. Get really, really comfortable with 401k. I recommend 401k because it's the most popular plan that you're most likely going to run into. So, you know, start with the most popular first and then work your way down. You know, go into 403b plans, go into 457 plans. And as you go, kind of just take mental notes of the similarities and differences between them.
Yes, and that's as you lay those down one by one, they have the same areas of comparison, let's say, or objectives we're trying to satisfy for the employer sponsor, but you start seeing the nuances. Do you remember a kid's song like "One of these is not like the other one, one of these is not like the other one"? That's what you start looking at in these plans, like, okay, all of these defined contribution plans have a 56,000 annual additions limit. But what makes them different? Well, it might be in the catch-up provision for that particular plan. It might be whether the employer contributes or not. It might be investing. So you just start mastering those one by one, and then you start to really feel what makes them different, which I think is what makes the good test question.
Definitely. So that is the employer side of the retirement plan family tree. Let's go over to the other branch we talked about towards the beginning, the individual retirement branch. I feel what really sets the individual retirement plans apart, where the first main segment is the tax-deferred versus non-tax-deferred plans.
Yeah, that tends to be driven a lot by who all do they want to benefit in the plan, and then that's usually linked to is it tax-deferred or not, or when is their constructive receipt. That's a big term in the non-qualified side.
Right. So first, the two most popular individual retirement plans, you know, probably something all of our listeners have at least come across is Roth versus traditional IRA. Those are the heavy hitters of the individual retirement plan world.
Absolutely. And you know, again, we're just matching up timelines and objectives and numbers with the client on whether we would go traditional or Roth. And so that goes back to the active participant side of things and employer sponsored to determine whether we have deductible contributions to a traditional plan, to a traditional IRA or not. That's kind of a first step.
Right. You know, I would say at its most basic elemental level, the way I separate them is Roth accounts are taxed now. Traditional accounts, traditional IRAs, that is, are taxed later. That is, I feel, the most basic distinction between them.
Yes, indeed. And then from a testing perspective, you read the full question, you read the story and say, well, what are they describing here? Common thought might be that, well, we'll be in a lower tax bracket when we retire. But, is that what the story is saying? Can we really make that assumption before we pick the Roth versus the traditional?
Right, exactly. And once again, it comes down to making some flashcards with some key bullet points between Roths and traditional IRAs and keeping them straight that way. They are a bit friendlier because they don't have nearly as many regulations as the employer-sponsored plans, but there are some kind of unique differences between them, especially when you get into tax savings and taxation at withdrawal.
Yes, and that, even thinking about the cases here that we highlighted, grabbing all that full information, doing the research and gathering the data before we make the recommendation. And that was the problem in that first case study.
And then from there, we have kind of this little subsection of retirement plans that kind of blurs the lines between individual and employer. And these are really the plans that are intended for self-employed individuals or people who own small businesses that only have a couple companies. And these would be like your KIOs, your SEPs, and some would argue simple. I feel simple really falls more under the employer sponsor plan, since there isn't really an individual option with the simple, but definitely the KIO and SEP really blur the lines because it falls under a lot of the regulations of the employer plans, but they are intended for either an individual, self-employed, or maybe someone with, one or two employees, real small operation.
Yeah, and that simplicity is the biggest reason they get adopted, really, particularly as a first step in the retirement plan arena. For instance, the SEP is the only one of the plans that can be established and funded as late as the due date for the tax return, including extensions. Everything else would need to have been set up before the end of the year.
Yep, I view the SEP as kind of the panic button option, where your accountant's like, "Hey, you should put some money in a retirement account to get this tax break," and like, "Oh, okay, open up a SEP right here. Let's make the contribution and be done."
Yeah, and that simplicity. I mean, you can just there's a form you fill out for it to adopt it. But that simplicity comes with, well, then if I have employees, I'm going to have to contribute for them, and they're immediately 100% vested. So there's trade-offs for this simplicity.
Yes, and you'll often find that with all the plans. IRS is very good at keeping a strict balance with these types of plans, and you'll see a lot of those trade-offs. Usually a benefit comes with, a con in another area.
Mm-hmm. Yeah, and again, that's great flashcard material. What's the best thing about this? What's the worst thing about this? What would a client be seeking for this to perhaps be the answer? Or what would they be avoiding for this to possibly not be the right recommendation?
Oh, yes. Yeah, there are. And that really does come up a lot with clients because of the complexity of the rules and the overlapping rules. There are still a few loopholes out there. We won't really get too much into them on this episode, but if you have someone who really knows retirement regulations and IRS regulations and is very comfortable with them, there's definitely some steps you can take to really maximize those contributions and get the most out of these plans.
Yep. And there again, that comes right back to this, let's do comprehensive and thorough gathering of information to really be able to give the right advice.
Yeah, I would make flashcards for each plan. I would also sketch out this kind of family tree of retirement plans that we've been mentioning. Start at the top at the trunk, and it's just retirement plans in general. Splits off into two branches of individual versus company, and then from there all the little split offs and diversions that the various plans have in their own unique direction.
Mm-hmm. Yeah, and then students will find themselves visualizing that on exam day.
Definitely. And then we won't get too much into it today because we're starting to run out of time, but also I would work on rollovers, which plans can be merged with other plans, what money can be rolled over from one plan to another.
Yes, and the difference between a traditional rollover, I guess is what I call them, versus a direct transfer, and which ones must there be mandatory withholding. That's just, again, universally applicable and also highly testable for CFP.
Definitely, 100%. So yeah, lots of content in that area. No real magic bullet other than putting in the legwork and, practicing them.
Absolutely. 100% agree, Jerry.
Well, Mike, we covered a whole lot today, and we got more on the horizon. I'm already looking forward to our next episode, but, if people want more right now, they just can't get enough. What are kind of the things we got out there for students who are looking for some more information?
Yeah, I hope that's what happens with this, Jerry, that we, maybe intrigue some folks that they want to know more, and will get a hold of us. We'll write in and ask for more explanation or conversation about these topics, or like today, recommend something that you'd like for us to to toss around a little bit. Our Kiddie tax discussion came straight from a student question that came in. So please do that. And then keep watching on the website and in email, because we are really starting to crank out new and exciting materials and reference resources. So stay in contact with us.
Definitely. We got the newsletter. We have all the YouTube videos. We have lots of other, tips and tricks that come out. That we have, resources I'm putting together right now. Actually, kind of a breakdown of all the different investment formulas and really putting it into context as far as, how you use them in the real world. Instead of it just being this abstract formula that we teach you how to do and you know how to do it, but you don't really know what it's used for. I'm trying to kind of paint the picture to how you can use this in real life to, even choose your own personal investments using these formulas.
Yeah, I love that. I saw the first several that you did. And again, I like how you're breaking it down. Like, what's the deal with this and why is this important? How would you use it? I think it's going to be an incredibly popular, I don't know, are we going to call it a cheat sheet or what would we call it? I just call it really good.
Yeah, we'll brainstorm some names for it, but yeah, keep an eye out for that. That should be coming out soon. And if you have ideas for other things that you think might help you, definitely let us know. We're always looking for new material that we can put together for you guys.
Yeah, we'd love it.
Awesome. Well, I think that does it for today, Mike. I will see you next time and hope you have a great day.
Thanks, Jerry. You too. Thanks for everything you do to help our students just every single day on the front line.
Oh, you too, Mike. You too.